All right, today we are putting on our detective hats and diving into a company's finances. Our mission, should we choose to accept it, is to get a handle on accounting adjustments. Now I know, that sounds kind of dry, but trust me, these aren't just boring entries. They're the clues, the breadcrumbs, that reveal what's really going on with a company's financial health. So let's start the investigation. So let's kick things off with a classic little puzzle. A company gets a massive check. $12 million, paid up front for a year's worth of service. That cash is sitting in their bank account right now. So, are they $12 million richer today? I mean, it seems like a no-brainer, right? But in the world of finance, the most obvious clue is often the most misleading.
And yeah, the answer is not exactly. See, that cash isn't just free money. It represents a promise. It's an obligation to do work in the future. And figuring out how to properly account for that promise, well, that's where our real detective work begins.
So here's our game plan. First, we're going to look at why cash itself can sometimes lie. Then, we'll dig into two crucial timing clues, accruals and deferrals. After that, we'll tackle the tricky business of uncertainty, zoom out to see the bigger corporate picture, and then finally, we will crack this case wide open.
Okay, first things first, why you can't always trust cash. I mean, just counting the money coming in and going out, sure, it's simple, but it gives you a totally warped view of how a business is actually doing. A company could look like it's rolling in dough one month and then totally broke the next. It's just too volatile. And that's exactly why we need a much smarter method called accrual accounting.
And the absolute golden rule of accrual accounting, the #1 rule for any financial detective, is something called the matching principle. The idea is actually pretty simple, but it's incredibly powerful. You have to match your expenses to the revenues they helped you earn. So if you make a big sale in June, all the costs tied to that sale also have to be recorded in June, even if you don't actually pay the bills until July. This is how we get a true, honest picture of profitability for a specific period.
All right, let's move on to our first big set of clues, accruals. This is all about recognizing that something of value has happened, like you've earned revenue or you've incurred an expense, before a single dollar has actually changed hands.
You'll see here that accruals are really two sides of the same coin. Over on the left, you've got accrued expenses. A perfect example is employee salaries. They worked the last week of December, but payday isn't until January. Well, the company got the benefit of their work in December, so thanks to our matching principle, it has to record that salary expense in December. Then on the right, accrued revenue. Let's say a consulting firm finishes a huge project on June 30th, but they don't get around to sending the invoice until July. It doesn't matter. They did the work and earned that money in June, so they have to record that revenue in June. It's about when the value is created, not when the cash shows up.
Now for our second set of clues, deferrals. And this is basically the mirror image of accruals. Deferrals are what we use when the cash moves first, way before the service is actually delivered or the benefit is used up.
Let's run through a quick scenario here to make this totally clear. Imagine a company pays its entire annual insurance bill, a cool $12,000, all at once, right on January 1st.
So, here's the question for you. Does that mean the company just had a massive $12,000 expense in January, completely wiping out its profit for the month? Or is something else going on? And here's how you solve that puzzle. First off, that $12,000 payment isn't an expense at all. Not yet. It's actually an asset called prepaid insurance. The company has basically bought a year's worth of coverage. Then, at the end of every single month, we make what's called an adjusting entry. We take 1/12 of that asset, $1,000, and move it over to insurance expense. And what's the result? Boom! We have perfectly matched 1 month's worth of insurance cost to 1 month of doing business. It's beautiful. And this right here brings us full circle to that big question from the beginning. That $12 million the company got up front, that, my friends, is deferred revenue. It's not income. It is a liability on their balance sheet. It's a huge IOU saying, we owe our customer a year's worth of service. The company only gets to recognize that money as real revenue little by little as they actually deliver that service over the next 12 months. Okay, so far we've been dealing with timing issues. But what happens when the future is, well, fuzzy? Businesses have to account for costs that are probably coming, even if they don't know exactly when or for how much. And that's where provisions come in.
You can think of provisions as educated guesses about future bills. If a company sells, say, 1 million laptops, they know from experience that a certain percentage of them are going to need warranty repairs. They can't just wait for those laptops to break. they have to set aside a provision for those future repair costs right now, matching that potential expense to today's sales. Same thing for stuff like ongoing legal battles.
Now here's where it gets really interesting. The rulebook for this stuff isn't the same everywhere. Under the international rules, IFRS, you have to book a provision if a future cost is probable, which basically means more than a 50% chance. But under the US rules, or US GAAP, that word probable means something much closer to almost certain. It's a way higher bar. So why should you care? Well, imagine you're comparing a European car maker to an American one. The European company might look less profitable, but it might not be because they're a worse business. It could just be that IFRS rules are forcing them to recognize potential future costs much earlier than their American competitor. It's a super important detail for making a fair apples-to-apples comparison.
Okay, on to the final major piece of our puzzle, intercompany eliminations. This is absolutely essential when you're looking at big, sprawling corporations that are really just a collection of smaller companies or subsidiaries all under one roof.
The easiest way to wrap your head around this is to think of the whole corporation as one big family. If I lend my sister $20, our family's total net worth hasn't changed one bit, right? The money just moved from my pocket to hers. It's the exact same logic for a corporate group. The whole point of a consolidated financial statement is to show how the family did when dealing with the outside world, not with itself.
So to get that true external picture, we have to go through and eliminate all those internal family transactions. We have to cancel out any loans between two subsidiaries. We have to get rid of the revenue from subsidiary A selling parts to subsidiary B. And we even have to eliminate something called unrealized profit. That's when one part of the company sells something to another part for a profit, but that item still hasn't been sold to an actual outside customer. It's all about making sure the group doesn't look bigger or more profitable than it really is.
Okay, team, let's wrap up this investigation. We've followed the clues, we've gathered the evidence, and now it's time to reveal the real truth that's been hiding in the numbers all along.
You know, it all really comes down to this idea right here. Making these adjustments, it's not just some bean-counting exercise to follow the rules. It's a critical task. It's about a commitment to making sure that the financial statements tell the real economic story of what happened.
So, let's review the case file one last time. Here are the key things to remember. First, the matching principle is your North Star. It guides everything. Second, accruals and deferrals are your go-to tools for fixing all those timing mismatches. Third, provisions are how you look into the crystal ball and account for an uncertain future. And finally, eliminations are what you use to strip away the internal noise and see the true performance of a big corporate family.
So I'll leave you with this final thought. The next time you look at a company's financial report, don't just glance at the revenue or the cash flow. Dig a little deeper. Look at the adjustments. What promises is that company making with its deferred revenue? What future storms is it bracing for with its provisions? Because that is where you find the real story. Thanks for joining me.